The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A rare day where stocks, bonds, and the dollar are all weaker in unison. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. We're kicking you off to the closing bell, but man, that is a quiet day.
Really quiet. Don't fall asleep.
No, I'm going to try not to, but for 2 days in a row, it really feels like we're seeing some lackluster trading across the major indices. The S&P is down 0.7%, so around the lows of the session, but volume is still quite light. Now, where you are seeing the action is in gold, the dollar, and the bond market. So, Romaine, we continue to see the dollar and the bond market trading together. So both of them trading lower, yields up, dollar weaker, and then the safety trade, gold picking up steam to the downside. The dollar yields and also gold, they tell a very specific story of anxiety, what should we say, and discomfort about U.S. debt, and that continues in the market.
Yeah, I'm really intrigued by some of the correlations in the market right now, particularly if you are trying to find some consensus on where the market goes next. A bit of a fool's errand at this point, but it makes for a good parlor game. The recent stock rally clearly outpaced fundamentals. We know that. Both the NASDAQ and the S&P flipping from oversold to overbought in just barely 6 weeks. Causing even more concern, though, is that the pullback today is not being countered by a bid to bonds or a bid to the dollar. Now, that correlated dip, which we also saw back in early April, that prompted KKR's Henry McVeigh to lament in a research note today about how government bonds are no longer, in his view, working as an effective hedge. He says that with bigger fiscal deficits and stickier inflation on the way, that traditional yin-yang where bonds should rally when stocks fall, that will break down even further.
Situation is a real mess. I've written about it that the spending is out of control. We've got to see a fundamental change in the spending system.
Now, while McVeigh didn't directly reference the multi-trillion-dollar tax-cutting, Medicaid-slashing bill working its way through Congress, we'd be remiss in not drawing the link ourselves. House Speaker Mike Johnson making the rounds through the Capitol with President Donald Trump today, trying to end the squabbling among the last remaining Republican holdouts that are needed to squeeze that big, beautiful bill out the door, a bill that was ostensibly supposed to provide even more support, Alex, to the stock market rally.
Which then begs the question, are we seeing actual support for the equity market, or are we just seeing sort of positioning? And this chart says that maybe, guys, we've run out of steam. This is the NASDAQ 100, and you can see the huge rally that we've seen since earlier this year, right? When we hit that bottom in April. The second panel here is the RSI index. Anything over 70 means that we're overbought, and we hit that level as of yesterday. And then down here are the number of stocks in the NASDAQ 100 that are over that 70 RSI. And you can see we're almost touching 30 at this point. So if you got short covering maybe done, funds like CTAs and volatility funds have already bought what they needed to buy. Is FOMO enough to keep the market going, or are we just naturally going to roll over here in the absence of any actual good news?
All right, well, let's pose that question to our first guest, Alex. Jitania Kandhari joins us right now, Deputy CEO of the Solutions and Multi-Asset Group with Morgan Stanley Investment Management, here in Studio 2 to kick us off to the close. Great to see you.
Likewise.
When you look at the market pricing, particularly over the last few weeks, and maybe we can take the last couple days out, which are kind of a little bit off kilter here, do you get any sense here that there is real conviction in bidding stocks up even higher, at least here in the U.S.?
I think the market has been doing okay initially because the first quarter earnings have been very decent, and I think the impact of the tariffs, the implications on both businesses and consumers is still to come, and I think we have to really wait and see on what all those indicators suggest to really aggressively buy here. And lastly, I'd say I think the case for international is looking more and more compelling as days go by in the market and in the dollar.
Okay, well, let's go there then, since you took us there, because there were some great notes out just this morning here talking about the potential outperformance, continued outperformance, I should say, of European assets relative to the U.S. JP Morgan had a really bold call, something like a 25 percentage point differential between where they see the stock 600 in Europe ending the year and the S&P 500 ending the year. Do you also have that same type of bullishness for European assets?
Yes, I do like different pockets of the world. I think it's important to understand in the last 8 decades, you've had 4 decades with international, as in ACWI, ex-US outperform, and 4 decades with US perform. So you can have points in time that the international space starts outperforming, Europe being one point, but even other markets like India, some other emerging markets, pockets of Japan, all look very interesting given where they are from a growth growth, relative growth standpoint, valuation, and most importantly, on the economics, from the economics of those markets where monetary and fiscal policy may be getting more supportive in the rest of the world rather than the US.
But they don't have tech in the same way that the U.S. has tech. I realize today when we have NASDAQ down 1%, that's not the best case to make. But the idea is that the U.S. exceptionalism has to continue because we have AI and we have tech.
I think even within the AI space, it's time to be moving to the adopters of AI. And I think we find different pockets of those in the B2B, which is business to business, and business to consumer, B2C, in international markets as well. So whether it's in the enterprise software, whether it's in cybersecurity, or even the FANG equivalents in other international markets. So where are the media digital platforms, or the music digital platforms, or the e-commerce digital platforms that are now prototypes of some of these FANG equivalents, but in other international markets? And I think we find enough opportunities in both the tech space, but even outside of technology, where domestic demand and financials and other pockets of these markets may be looking interesting.
So the valuation call for Europe, for example, has been around for a really long time. So my favorite question is, why are you so short right now?
My chair just keeps lowering here.
I thought we were going to take a wide shot, and we took a wide shot.
Right.
I had to address how short you were.
I'll just adjust my chair.
So my point is that we've heard the valuation part for a while, so why now does it make sense?
Two reasons. At this point, it's the equity valuations and the currency valuation. So I think given where we are in the dollar and the rest of the G3 FX and emerging market FX, I think the valuation of the currency is an important element at this point. And I think you finally have the catalyst to unlock that valuation, right? We've been relative valuations, we've been arguing Europe is much, much lower, but now fiscal policy is more potent. The currency valuation is more potent. The consumer is sitting on a bigger surplus than the US consumer.
Do you worry at all about any of the geopolitical risk? And we don't talk about them as much because I know some of the trade issues and the budget issues now have kind of become front and center. But we still have a lot of unresolved geopolitical conflicts that do have potential ramifications for that global trade, if that is what you're pursuing.
I definitely worry about it, and therefore the portfolio has got enough geopolitical hedges in the form of either gold or gas, which will become an important commodity to address the trade deficits with the US, where US will say, buy some gas from us to reduce the trade deficit with different countries, or even whether it's defense names and other geopolitical hedges. So I think you need to have enough of that in the portfolio to kind of overcome some of this volatility on account of that.
So basically, what other people are going to buy from us is stuff that you would like.
Yes, I mean, I think they also have enough of their own to buy, in the sense there is enough of interesting opportunities in different segments, in industrials and financials, etc. But I think in some areas like gas, in some electronic components, in airlines, there could be some deals which can help some of these US companies as well, because with the dollar depreciating and them being exporters, they can actually be good stories.
And you expect that dollar weakness to continue?
I do.
All right, Jitania, great stuff. Always great to talk to you. Jitania Kandhari, Deputy CIO of the Solutions and Multi-Asset Group at Morgan Stanley Investment Management. Kicking us off to the close, we should point out stocks now hitting session lows, and you're actually seeing some big reversals in some of the big gainers on the day. That includes Home Depot, who was up as much as 2%, now down about 1%. This after reporting better than feared guidance for 2025. We're going to talk to an analyst and get his take here on where Home Depot and that stock goes next.
All right, coming up, speaking of uncertainty, a look at how that is shaping the Federal Reserve's wait-and-see approach. Just 1 month until the Fed's next meeting. We're going to discuss what to expect. Rich Clarida, Managing Director and Global Economic Advisor over at Pimco.
And from Fed sentiment to C-suite sentiment, a look at the factors hitting business leaders hardest. Kevin Kajiwara, the co-president of Political Risk Advisory at Teneo. He'll be joining us a little bit later on the program. Stick with us. This is The Close on Bloomberg.
I made the point. Obviously, I respect the president's perspective on this. We want to get a bill passed. We don't want the tax cuts to expire because that would be the largest tax increase in American history. But we need to come to an agreement. And I've been very clear from the start that I will not support a tax bill that does not provide real tax relief to my constituents, and that requires lifting the cap on salt.
That was Republican Representative Mike Lawler speaking to Bloomberg's Tyler Kendall earlier today about why he won't support President Trump's tax bill unless the SALT cap is lifted more. House Speaker Mike Johnson also meeting with GOP holdouts again this afternoon. Let's get more context with Wendy Schiller, professor of political science at Brown University. Professor, this level of debate over SALT, how do you think it resolves?
Well, I think that the blue state Republicans, and not that many of them, probably get a number like 30 grand, maybe 25, 30, as opposed to 10,000. And they'll take it because it's better than 10,000. And, that's, I think, the wheeling and dealing that will happen. I think there's no question this is the singular legislative accomplishment for the Republican Party, the majority party in the House of Representatives this year. They haven't done much of anything else. The president's really grabbed a lot of power, even more power than previous presidents. Mm-hmm. And, if they want to go home and campaign on something that isn't Donald Trump, they have to really have to pass the tax bill.
Well, I'm sorry, just curious, Wendy, though, I understand that it's a big legislative achievement, primarily because they haven't achieved a whole lot else. But I'm also curious, as it seems like so many elements in this bill go directly against a lot of the things that the president himself campaigned on, as well as some of his surrogates in Congress. And I'm just curious as to how they're going to sell this to the American people. And I don't mean, the moneyed class, the donors. I mean, just the rank and file voters. Are they going to buy in to what's into this bill?
Well, so far we've seen signals from people who say they voted for Donald Trump at these town hall meetings and other social arenas where they've expressed opinions. They've been very unhappy with cuts to the Veterans Administration, very unhappy about potential cuts to Social Security, or even cuts to phone lines to Social Security. So it's unclear that this is going to be a winner in that particular population. There's a really slim number of people that the GOP needs to appeal to keep the House in 2026. And the tax cuts are what they're going to sell. They're going to say, look, we promised you could keep the tax cuts, and we delivered, and we're cutting spending. The problem is the tax cut cost way exceeds any kind of cuts they're doing right now in spending. So we have a deficit, and that deficit is not going to go down as a result of this bill. So the real fiscal hawks that promise their constituents they'll cut federal spending are going to have to explain why the bill they passed didn't really do that.
Going back to the SALT cap, it looks like from reporting what passed the committee was 30,000. So, and raising the cap to that. So why still the holdouts?
Well, if you can try to get more, you try to get more. But there's another element in this geographic mix, which is Medicaid. The states like Louisiana, 70%. The federal government pays 70% of their Medicaid costs. So some of those deep South, deep red states really rely on the federal cost share, and they're not touching that, thanks to Mike Johnson. But places like California, New York, Illinois, they have very high Medicaid bills. So they're also trying to position themselves to hold out to make sure that the hardliners don't cut Medicaid more than they already say they want to. By the way, the House bill will probably get modified by the Senate. It's unlikely, senators represent entire states. That means you've got people who are very wealthy and people who are low income on Medicaid all voting for Senate. So I think that's where we're going to see some modification on the Medicaid spending cuts.
Is there a sense, though, and I mean, let's assume that at least based on what we know about the contours of this bill, it does actually make it through and is signed. Is there a sense here that some of the provisions in there over time will actually help to compensate for those tax cuts, meaning some of the issues with fiscal, having more of a balanced budget and dealing with the fiscal deficit, does that get made up in some way or another, either from, this magical tariff revenue that we should be getting or other provisions in there baked into the bill?
Well, Romaine, I've been watching politics a long time. This federal budget just keeps getting bigger and bigger. It doesn't matter if the Democrats or Republicans own the White House. It just keeps climbing. So yes, maybe if the economy booms and you have additional tax revenue, even with tax cuts, more people working, more people making money, more tax revenues flowing in, you might make a dent. But if you're going to increase defense spending, when there are mixed signals out of the White House of whether that's going to happen, and you're not going to cut Medicare, and you're not going to cut Social Security, raise the age of full Social Security benefits, you're not doing any of that, over the longer term, I just don't see where all that revenue comes from to balance things out. Remember, the Medicaid cuts, at least I think in the House bill, don't happen. Those requirements don't even kick in till 2029, unless they're going to change it now in the Rules Committee. But that's 2029. Yeah. That's after the midterms and the next presidential election. So you're not looking at cuts anytime soon.
Okay. So there are no fiscal conservatives left in Washington, is what you're telling me. I'm not even trying to be funny here. I mean, where are they? Where are they?
Well, I think that ship has left the port a long time ago, even starting with Ronald Reagan. And there's just, been an expansion of the federal government under Republicans, George Bush, Prescription Drug Act, under Medicare, to wars, to Obamacare. It just keeps growing. I will say, I think there might be a few Republicans who don't vote for this bill and a few Democrats who do because of the tax cut element. So let's look at the Democrats from competitive districts and see whether they, in the end, end up voting for this bill.
All right, Wendy, great stuff. Wendy Schiller, one of the brightest minds out there, professor of political science at Brown University. And we should point out, Bloomberg will have an exclusive interview with House Speaker Mike Johnson. That's going to air tomorrow morning at 9 a.m. Eastern time. Definitely tune in for that. And, of course, we'll keep tabs this afternoon on that bill as it works its way through Congress. Heavy lobbying going on right now by House Speaker Mike Johnson, as well as by President Donald Trump himself. Meanwhile, we turn back to the markets and take a closer look at shares of Home Depot. They rallied earlier in the day, then took a dip a little bit later. We're going to break down the earnings that we got this morning and speak to an analyst who covers the stock. Stick with us. That's coming up in our Stock of the Hour. This is Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start off today with Chubb. Deutsche Bank cutting the stock to hold and trimming the price target down to 303. The analyst sees a focus right now moving toward the insurer's weakening underlying fundamentals and warns that Chubb faces outsized exposure to the insurance pricing cycle. Those shares down about 0.8% here on the day. Next up, let's take a look at Hewlett-Packard Enterprise. Evercore ISI upgrading to outperform, citing a favorable risk-reward ratio. The price target getting bumped up as well to 22 from 17, with the analysts encouraged by the company's strategic moves, including the Juniper Networks deal. Those shares up about 1% on the day. And finally, Kroger. Melius Research lifting its recommendation to hold and raising the price target to $70 from 58. Melius seeing limited exposure to tariffs within the retail landscape. The firm also adding that Kroger's digital and delivery capabilities will help drive traffic and mitigate share losses. Those shares now on a 4-day win streak, and those are some of our top calls. We're also going to stay in the retail sector right now and take a closer look at Home Depot. The share is fractionally lower on the day after being fractionally higher after it did maintain its full-year guidance when it reported earnings. Executives indicating that their belief that the worst economic concerns have passed and they don't expect broad price increases on their customers from those tariffs. Michael Baker joins us right now. He's managing director at D.A. Davidson. He's got a buy on the stock and a price target of $470. Let's start off with those tariffs and, more importantly, the pricing, Michael. I think it's interesting that they kind of made it clear that they think they can hold the line on pricing, not having to basically raise them by much. Is that because they're absorbing their costs, or they're not actually taking any of those costs to begin with?
Well, I think it's the more absorbing it, but really the term I would use is they're offsetting it. They're seeing lower costs in their supply chain just through some efficiency gains. They've actually done a really good job with shrink. Remember, that was a big issue a couple of years ago for retail. That's been a positive for them. So those sort of give them the gross margin currency, if you will, to absorb some higher costs without it really impacting the margins. And I will say, in general, they said they're not raising prices on a portfolio of products. To me, that means that some prices might go up, some might go down, but when you look at the entire basket, probably about neutral.
So when you saw the earnings today, and more importantly, when you start to look at the guidance going forward, you're comfortable with that, Michael?
Sure. You know what's interesting about the results and the guidance is that they comped positively in the U.S. This is now the second quarter in a row of positive comps. That follows 3 straight years of negative comps. The trend throughout the quarter was actually pretty strong. February was a soft month, but it got better in March and April. April as a month was the second best month that Home Depot has had in the U.S. in terms of same-store sales, going back about 3 years. And that momentum has continued into May. So that makes us comfortable with the 1% comp for the full year. In fact, April was a little bit above that. Now, let's be clear, 1% is not where it should be. In the past, they'd comp 3, 4, 5% every quarter. But in the current environment, where housing is still pretty soft in terms of existing home sales turnover, the fact that they're getting positive and staying there is not too bad at all.
We definitely did see, though, a deferral of big ticket purchases for the smaller ticket items. And I'm wondering, when does Home Depot need those big projects to come through?
Well, for them to get back to that 3 or 4% type comp, you would need to see some of those projects come through. And for that to happen, I think we need a little bit more activity in things like HELOC spending, lower rates, et cetera. That also is turning positive. HELOC dollars are going up, but just not being spent enough yet to drive those big ticket purchases. A lot of those big ticket purchases are financed, and rates are still a little bit too high for that. We'd like to see those rates come down maybe 50 to 100 basis points, and that's where I think you'll start to see a lot more activity there, and that's where you'll get same-store sales back to that 3 to 4% level.
All right, so it's a wait and see, just like the Fed has having to wait and see from that end. All right, what is this? What's the read-through to Lowe's?
Well, Home Depot did beat by a little bit today, at least on the comp line. If you look at the average spread between Home Depot and Lowe's over the last year or so, it's been about 1 percentage point in Home Depot's favor. So if that spread holds, Lowe's would have to comp down about 1%. The consensus estimate is down 2. In other words, Lowe's tomorrow needs to beat on the comp line in order to hold that gap.
All right, Michael, thanks a lot. Really appreciate it. Michael Baker, Managing Director at D.A. Davidson. And I just feel like, Romain, we're hearing this from CEO and CEO that eventually, when do deferred projects become non-existent? And when are they just deferred by 3 to 6 months? And when are they just canceled?
Yeah, and we've been down this road before. And I mean, that's the problem is how do you sort of assess that? I mean, we've seen in the past that you've ended up being wrong sometimes in thinking that those deferments are actually completely put off, and then vice versa. And it's not necessarily in line with just one company. Home Depot might benefit, Lowe's may not. It might be the reverse.
Exactly. And also you can make an argument for like banks and M&A, same thing, right? Like, is the deal going to be deferred or is it going to be just nixed?
Yeah.
And not having that clarity, which brings us to what the Fed will do, which brings us to our next segment.
Ooh,
See that? You're going to like the Fed's path ahead. We're going to talk about that with Rich Clarida, Managing Director and Global Economic Advisor over at Pimco, with Fed officials sort of outlining a 3 to 6 month window when they'll get more clarity on what the economy is going to do and then more clarity on what they can do. This is The Close on Bloomberg.
I think the Fed right now should not cut should not cut interest rates, and it's in a very difficult position to try to balance these things. There's a great deal of uncertainty, and there is a deterioration in sentiment, but really the actual economy. So they're in a difficult position.
3:30 p.m. here in New York. This is the countdown to the close. That was Ray Dalio. I'm Romain Bostic.
And I'm Alex Steele. And you can definitely hear Ray Dalio talking about how tough it is to beat the Fed right now. He was speaking to Sonali Basak earlier at a BNP Paribas conference, saying that the Fed shouldn't cut rates at this time, ... But the when is the big question mark.
Yeah, and that's the when. I mean, hasn't the Fed said that repeatedly? I mean, we just had some headlines a little while ago from Raphael Bostic, who's speaking for like the 12th time this week. And he kind of made that clear. Again, this is the idea. The Fed has basically made it clear. They have no uncertainty. They can't really do anything until they have that certainty. If you believe John Williams, that may not come to September, maybe even later, which I don't think is what the market wants to hear.
Yeah, and here's a... Go ahead,
no, go ahead. Go ahead, Alex.
Okay, I was going to say, but Morgan Stanley, Michael Gapin just out with a note saying that he expects no Fed cuts until March of 2026.
What?
Yes, and then 7 times in a row, 25 basis point cut. Yes,
okay.
Exactly.
Right.
No rate cuts until March. Let's get more perspective on this with Rich Clarida, Managing Director and Global Economic Advisor over at Pimco. A big reason for that, for Michael Gapin, Rich, it's good to see you, is that inflation is going to firm up now, but unemployment rises next year. Could that be a plausible scenario? No cuts till next year?
You know, it could be a plausible scenario. Our baseline view, Alex and Romain, is we'll begin to see a pickup in the unemployment rate later this year, and that will put the Fed into the mode of cutting rates. But it's entirely possible that the Fed does not cut until the end of Jay Powell's term. It's going to be very data dependent. They're not going to be preemptive and try to get ahead of the curve this time. So I think wait and see is the message out of the Fed right now.
And they've been making that loud and clear. Would you guys think that the Fed is really leading when it comes to market reaction and the economy, or is it really going to be tariffs and the tax bill?
It's tariffs, it's the tax bill, and of course every week we get new information on the tariff. There are some deals announced. There are some other indications that other countries may be hit with an additional tariff. So there's a lot of uncertainty. I think that the thing to remember is that in the past, including during my time at the Fed in 2019, the Fed had the room to act preemptively. We cut rates in 2019 based upon a forecast of a slowdown. The difference now, of course, is inflation is above target and has been above target for 4 years. And I think you add the uncertainty on top of that, and that gives you the Fed on hold situation that we see today.
But don't we have a sense, Rich, that we kind of know to a certain extent kind of where some of these metrics are going to go over the next few months? And we may not know exactly what it's looked like, but I think most people understand that inflation probably is going to be higher over the next few prints than what it was in the past couple of prints. And we could even see some potential weakness in the labor market. And I know that that's not enough for the Fed to preemptively act. But at what point, when you guys are all in that room, do you kind of say, okay, this is now starting to add up to something?
Yeah, well, of course, I'm not in that room anymore. I can speculate. Certainly what I believe is if we get an increase in the unemployment rate, say to 4.7, 4.8, I think that would be enough to get them off the dime. There are others who think maybe somewhat less of a rise in the unemployment rate. Remember, they've already looked through what was a negative print on GDP growth in the first quarter. I think they understand that really understated the economy's strength, and importantly, the economy came into the year, with a very good situation in the labor market and in the economy. So there is that momentum as well.
With regards to the tariffs and the potential impact on the economy, on supply chains, et cetera, I thought some of the comments from the New York Fed President John Williams the other day were interesting because he kind of said, look, in his view, he said maybe September we'll have a better look at what that impact is, which, for the market almost seems like, might as well, he said 10 years from now. But it gets to this idea. And I think we all sort of think back to the pandemic and the supply chain disruptions there. And now the Fed was saying, look, this might be transitory. Let's wait and see. Let's wait and see. And we know with the benefit of hindsight that they were wrong on some of those issues. And I'm curious if there's that same impetus to not be wrong, maybe this time around, and not repeat that same mistake.
Raphael, I think that's a fair point. I think that there is some path dependence in monetary policy. I think in particular, because, and I was there, of course, in 2021, and in particular because inflation remained above the 2% target in 22, 23, 24. And I think we're also seeing, for example, in some of the survey estimates, an increase in expected inflation. I think all those factors put together does put the Fed in a wait-and-see mode, whereas in the past they might have been more preemptive.
Rich, I just want to point out real quickly here. You called me Raphael, and let me just say, if I'm going to be confused with anybody,
sorry.
I'm glad you.
I'm sorry, you had that on the. Yes, you mentioned Boston.
That's fine. I'm glad you conflated me with somebody way smarter than I am. So, but anyway, it's all good, Alex.
Okay, well, I'll take that into account next time. All right. Hey, Rich, we also can't ignore what's happening with the deficit as well as the budget bill and the tax plan that's going through Congress at the moment. The Committee for a Responsible Budget is saying that the net effect would add something like $3.3 trillion to the federal government debt over a decade. How does that need to factor in to the market, to the economy? What's the real impact?
Well, obviously, the U.S. is and has been on an unsustainable fiscal path, and I think that in some ways this is not a lot of news. I think the markets were already expecting an increase in deficits relative to the baseline path, and probably the Fed as well. I think an important offset, however, is if the 10% tariffs do stay on, and the Trump folks are saying that they have no intention to move away from the across-the-board 10% tariff, that's going to raise according to some estimates, nearly $3 trillion over 10 years. And so this is a very complex package. It's a big package. It's got tax cuts. It's got some cuts in spending. And the tariffs, which are not directly factored into that analysis, are also going to be relevant as well.
Well, also just the idea that if we take default for the U.S. off the table, right, we're always going to pay our bills. There will always be people who buy U.S. Treasuries and investors who buy U.S. Treasuries, but at what price?
Yeah.
And I'm just wondering, at what price do things get a little sticky in the economy? 5% in the 30 years, 6%?
Well, Alex, I'll put it this way. A term that we've used for a long time at Pimco when it comes to treasuries is that they're the cleanest dirty shirt in the sovereign debt closet. And so the reality is there was a global market for fixed income. And if you look at most major countries in the world, Japan, most countries in Europe, unfortunately, they've got fiscal pictures that look about as bad as the U.S. So, our baseline view is the dollar remains the global reserve currency and treasuries remain the global reserve asset, in part because there aren't a lot of viable alternatives. But you are correct. Rates are higher now than they were before the pandemic, and I think that does reflect the required extra premium that people require to hold treasury duration.
Well, does that constrain, though, the Fed? I mean, if we do get to a point where maybe we do need a little bit of economic support, does that constrain the Fed?
It's an interesting question because certainly in theory it should. If 10-year yields go up because the Treasury is having to pay more to borrow to roll over its debt, other things being equal, that slows the economy, and I think the Fed would factor that in. Indeed, I remember in November of 2023, the chair in the Fed more or less said that one reason they were staying on hold is that bond yields had gone up in that time. So long as it's reflecting an increase in the real borrowing cost and not expected inflation, I think at the margin it is a factor for the Fed.
All right, Rich, always appreciate you taking time for us. Rich Clarida, of course, one of the best in the business, now managing director and global economic advisor at Pimco. We should just point out real quickly here, Alex, stocks have been all over the place today. They're still in the red, but also yields, they're elevated again. They're back kind of bumping up against that 5% level on the longer end of the curve here. The short end of the curve, not as much action.
No, and it very similar to the price action we saw yesterday without the reversal. Yeah. As in, by 11 o'clock this morning, we were down 0.4% and yields were up 5 basis points. We just haven't necessarily reversed, but well off the lows for the S&P.
All right, there are quite a few stocks moving to the upside, but also quite a few moving to the downside, and that includes the owner of Viking Cruises. Rough seas ahead, maybe after the cruise line operator reported earnings. We're going to take a closer look at why those shares are down 5.5% on the day. This is The Close on Bloomberg. All right, shares of Viking Holdings, the cruise line operator, down almost 6%, despite the cruise line operator saying that first quarter revenue and adjusted EBITDA beat estimates. Analysts are concerned more about the 2026 bookings forecast and pricing growth trends, saying they show deceleration for the year. Jody Lurie joins us right now, who covers the stock for us over at Bloomberg Intelligence. And Jody, I am curious here about the sentiment around this, particularly given it just seemed like, a month or two ago, we heard from Carnival Cruise, which kind of said, hey, things are great for us. We're going to do well. What's the disparity between what's going on at Carnival and what's going on at Viking? Is it just different business models, different clientele?
It's completely different business models, somewhat different clientele, but very different business models. We're talking large ships versus small ships. While Viking does have their ocean liner, which is actually doing pretty well, a lot of it is river cruises, which are much smaller vessels.
So
you also have to think. Oh,
go ahead. Go ahead, Jody.
I was just going to say, you also have to think about the demographics. So Viking, a lot of their customers are 55 and older. They only appeal to adults. There are no kids on their ships. And usually it's about 2 people per cabin or sometimes 1 person. So it's a very different business model.
Romain got really excited about that point. But per customer, where is the strength? Is it with those the older demographic, or is it with the family that has kids?
So I would actually argue that I think that a lot of the movement in the stock is overdone. I think there was a lot of reading into it. And Viking's never been one to be very concrete with their estimates. I mean, you talk about a company that before its IPO, you could barely get financials even though their debt was always publicly traded. And so now here's a situation where they actually repaid their debt. So their net leverage is 2 times, which is the lowest among their peers. Royal Caribbean, which just got investment grade yesterday, is still getting to the 3 times level. So that's what we're talking about. We're talking about 2 times on net leverage, 3 times on a gross leverage basis. So I think they're doing actually relatively well, all things considered. That said, I think there's a lot of hesitancy to get comfortable with the company into 2026, particularly as we're thinking about the fact that Royal is coming into the sector in 27 with their river cruises.
So Jody, when we talk about this idea here of travel demand overall, and this goes just beyond Viking, is there a sense here that if we do believe that economic conditions globally are softer, does that mean then that we do see a material pullback overall in this travel space, in the cruising space, I should say?
So I think it's a little bit nuanced there, Romain, because when you think about it, first of all, people love to travel. What we saw with our travel survey, which we actually published over the last few days, is that people are still wanting to travel. Now, are they going to be spending as much as they were planning on spending at the beginning of the year? No. But there's still a large portion of people who are planning on traveling and traveling large. And particularly if you look at the male population, they're planning on traveling. So I think cruises just have to appeal to men.
Fair enough. Wow. And now I feel like we need to go and experience it. All right, Jody, thanks a lot. Jody Lurie, Bloomberg Intelligence, thank you so much for joining us. 15 minutes on the close of trading. We'll take you through it. This is The Close.
I think the market has been doing okay initially because the first quarter earnings have been very decent, and I think the impact of the tariffs, the implications on both businesses and consumers is still to come. I think the case for international is looking more and more compelling as days go by in the market and in the dollar.
Jitania Kandhari kicking us off to the close just about 50 minutes ago, Alex, and stocks pretty much where they were when we started the show, in the red, only fractionally, but definitely a big pause in that 6-day rally. You
pretty much look at most of the indices, and it's a V out the lows of the session that we hit about 20 minutes ago, with the exception, though, of the Dow Transportation Index continues right around the lows, led lower by the likes of FedEx, which I found quite interesting. And energy continues to be one of the worst performing sectors within the S&P. We saw it yesterday. We're seeing it today as well, off about 1%.
Yeah, well, the VIX is tamped down a little bit right now, camped around 18. And of course, you are starting to see a bit of a rise in some of those longer term yields, 7 basis points higher on the 30-year yield. As you get closer to these closing bells, with just about 9 minutes to go, David Bailin joins us here in Studio 2. He's the CIO of Capital Group. Correct.
CEO of CIO Capital.
I am very.
Just to make it
my apologies. It got a little confusing.
To be real clear.
Sorry about that, David. Great to have you here on the program, CEO of the CIO Group. David, talk a little bit about the complexion of that rally, which may be on pause, maybe it continues, but it was a rally that was driven by retail, and I saw a great stat yesterday about how the biggest concentration of retail buying that we had seen in history on a single day was actually yesterday.
Yeah. It's a pretty remarkable shift in behavior. Institutions with Liberation Day coming, took a very conservative view of what they should do and actually raised cash, moved more money into fixed income, and retail did the tremendous buy the dip, which has continued basically now for 3 weeks. Foreign investors have definitely taken a hiatus on the U.S. market. So there's a real dichotomy in what people's expectations are and institutional expectations are right now in the marketplace.
So give me a sense here as to whether the different disparity in expectations converges, or is this just kind of the path we're on right now, where people are seeing two different things, or at least interpreting two different things?
Yeah, they're definitely interpreting two different things. So, our basic view right now is that you're going to see a softening of the economy. People talk about the impact of tariffs, but the fact is that they filled up the warehouses. Then you're going to have a 4-month hiatus in terms of goods moving to the country. That will affect small and medium-sized businesses. And some of the data that you just spoke about, right, which is the FedEx doing less well in the market, energy prices down, are all indicators, right, of a softening economy, slowing of the economy, and we're going to see some unemployment of hourly workers coming up in front of us. that is what the institutions see, and they see that carrying on into 2026.
Right, and then retail is just like, we're conditioned to buy the dip. We're going to buy the dip. But retail is not going to be enough necessarily to lead us for another leg higher, right? So what do we need to see for that?
Yeah, so I think what we need to see is much more clarity about economic policy, both in taxes, and then we need to see what forward earnings are going to be. And we have to remember that we're only about 6 or 8 weeks away from those 2026 projections. Companies have been very loath to give us any real indication. They've actually pulled back earnings estimates. So that's what we're going to be looking for. And I think we're going to need to see the growth companies continue to power ahead, especially in AI-related implementations. That's going to be a big indicator of whether or not forward investment and capital investment continues into 2026.
Do you think, though, the economic conditions are going to be conducive to that?
I think the answer is maybe, and I think we're going to have to see basically a stopping, of the government's tendency to muddle into all of these things. Tariffs themselves are just a tax on the consumer at the end of the day. And so long as we have consistent policy, the tax bill is passed, we can really digest that, and then people have to decide if they can make the investment. So I would say the jury is out, and I think it's leaning to the negative right now.
There's a broader issue, though, also about just sentiment and the way people view the U.S. economy right now, U.S. policy, and in tune U.S. markets. And of course, a lot of hay was made about the Moody's downgrade, and we can debate whether that was a lagging indicator or not. But it's certainly something that everyone was talking about long before Moody's finally decided to sort of weigh in on this. The idea that deficits are getting too high, that's going to lead to higher borrowing costs, lead to higher inflation, and that will tamp down growth.
But when you look at what was talked about on Bloomberg in November and December of last year, it was all about U.S. exceptionalism, and that is gone. And so the idea of the U.S. leading in terms of the world economy, thinking globally, is gone. The whole idea of a stronger dollar is gone. So we're talking about an entire different regime change that's coming up, right? And what investors have not done is to begin to move money into international markets, to Japan, to China, right? Into Europe to a small degree. They have not done that. They have not diversified their risk even in the U.S., adding digital assets or anything to their portfolios. So I think that the investors are just not anticipating what is going to happen in 2026.
Yeah, but on the same side, we wind up getting FOMO in the U.S. Like, if that had been the thesis a few weeks ago, you would have missed like Microsoft's earnings and what happened with Meta. Like, a lot of the tech companies are still going gangbusters here, and you can't miss that. And that leads to its own sort of FOMO. How do you do both?
So here's how you do both. You think about portfolio quality. So this rally that we just saw had a lot of very poor quality companies, highly shorted companies that needed to have short covering, and that was a big part of the rally. And so what you just said is very important. Our clients need to move money into the highest quality securities, those with the biggest moats, the most likelihood of succeeding under this economic regime. For small and medium-sized stocks, there's much more risk today, and that goes for global companies as well. So I think portfolio composition is going to be the key to success as we go into 2026.
So how active then, oh my God, 2026 feels like so far away. How active then do you need to be?
I think you could see a portfolio shifts of 10 to 12% of entire portfolios now. Into specific sectors. That is a lot compared to a normal year. Into specific sectors, right? You talk about U.S. tech, but it's got to become international tech, including some exposure to China. We've got to look at the finance sectors in the rest of the world as very attractive investments coming up in 2026. All of these are going to be beneficiaries of these changes of policy.
And we have to just ask you, though, when we talk about the big structural themes, particularly that drove the rally last year, which was AI and all the tech spending in that, and you kind of alluded to this earlier about a continuation of that. Is that going to be a global story, though? Because it's been driven by the U.S., the U.S. companies.
We're going to move from this idea of the story being the investment in infrastructure and data centers to the investment by companies in upgrading their own technologies and implementing them in their businesses. And what we want to see are companies that are driving higher earnings growth by the use of AI, which should become the theme in 26 and 27. That has not become clear in the earnings so far. Right now, it's all about the investment. And so we're going to see that translation in a bunch of service businesses.
All right, David, great to catch up with you once again. David Bailin is the CEO of the CIO Group here in Studio 2, counting us down to those closing bells. Those bells now just less than 3 minutes away here. Most of the major indices still holding in the red. And kind of interesting to see the individual names that are moving here. No real help from the Mag 7 today. Tesla, the only member of that group that's in the green, and that's only 0.5%.
Yeah, and also what's pretty staggering, though, is how extended we are above moving averages for the major indices, and yet we're still holding around those levels.
And you pointed out at the top of the show that the RSI is showing that we're back into sort of overbought conditions, or at least we came in today in overbought conditions on both the S&P and the NASDAQ 100. Both of those indices in the red right now. As we break it all down for you right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Alex Steele, taking you through that closing bell, a global simulcast. It starts right now. Scarlett Fu in the TV studio, Carol Massar, Tim Stenovic in the radio booth. Welcome to our audiences across Bloomberg Television, radio, and our partnership with YouTube. Another sort of middling day in the markets, Carol Massar, but this time, unlike yesterday, firmly to the downside.
Yeah, exactly. I mean, bouncing around here. We were talking with our Eric Weiner here at Bloomberg News, who covers the markets, and he said some of that downturn that we saw in the 2 o'clock hour had to do with some of the comments that Elon Musk said on a competing network about robo-taxis and kind of prioritizing that. That's an expensive cost. There's a lot of questions to be figured out by that. So his take was that maybe there was some nervousness in the market. Keep in mind, you know, Tesla's about 2% of the S&P 500 and more than 3% of the NASDAQ 100. So possibly putting some pressure there.
Yeah, I mean, earlier in the session, Tesla was higher by as much as 3.8%.
Almost 4%.
Yeah, so that was pretty big. Yeah. Then it moved lower. Now it's, you know, just about half a percentage higher. But 6 of the 7 other Mag 7 stocks are actually lower right now. NVIDIA and Apple dragging the index down.
You know, when you take a step back, there's no real significant economic data, at least so far this week, right? We had leading index yesterday. We had the Philly services today. So we have a momentum-driven market for the most part. In equities, it basically means recovering from that post-April 2nd drop, and then you have a weaker dollar, and of course you have higher yields. But the actual levels day in and day out, you're just kind of tweaking around the margins.
Yeah, good point. We're also headed into a 3-day holiday weekend here in the United States here, so that's going to have a big effect as well. We are expected to get some earnings after the bell tonight, including from Toll Brothers and Palo Alto Networks as we get the closing bells here in New York. Right across the screen for most of the major indices, the Dow Jones Industrial Average down more than 100 points or 0.3%. The S&P down 23 or 0.4%, while the NASDAQ falling by a similar percentage amount. And your bright spot on the day, that's going to belong to the Russell 2000. Outperformance up 1 point. Or less than 0.1%.
All right, so a little bit of outperformance there. Hey, looking at the S&P 500, going back to the big caps, folks, most names in the index lower in today's session, 328 to the downside. Scarlett, 173 actually gaining some ground here.
All right, let's take a look at the IMAP. A lot of red on that screen, and the worst decliners on the day are energy stocks, down by about 1%. That was the same case as yesterday, and in fact, energy is down about 3% so far this year. Communication services, consumer discretionary, also lower by at least 0.5%. On the upside, there are 3 slivers of green pies slices. You have utilities, healthcare, and consumer staples, so pretty defensive sectors there.
All right, guys, let's get to some of the individual gainers. A lot of red there, but Moderna, definitely one of the outperformers at its highs, up almost 15% in today's session, finishing the day with a gain of about 6% here. It's had like a 2-day gain of about, I want to say about 10-12% here. Up today, along with shares of other vaccine makers, including Novavax, after the FDA outlined an approach on the path forward for COVID shots that is viewed as better than expected. U.S. regulators, they will no longer approve COVID booster shots for healthy adults, nor for children without new studies, adding a costly requirement for drug makers, though they will still be available for millions of high-risk Americans. So the point is the agency's willingness to continue making the shots available for high-risk people with a wide range of health conditions was kind of a relief to the industries. They feared a kind of a bigger wave of restrictions from the Trump administration, so we didn't get that.
Hey, a restriction on COVID shots?
Well, yeah, meaning, like, or basically saying maybe people didn't have to get these, vaccines.
Okay. But if you want to get them, you can do that, right?
I guess you can do
this
that.
is still America, right?
Yeah. Well, I guess so.
Oh, okay. I'm just checking.
I guess so.
Will insurance cover it? That's a question.
That's a good point, right? When there's mandates and so on.
Yeah.
Magnite is another company that was definitely an outperformer. It was up.
Am I allowed to buy this or not? Sorry.
Calgary.
Wow, that was a sigh.
It's up about 11% at its highs, up about 5% here at the close. It's something kind of different, guys. I just threw it out there because I knew Romaine would love it. It's about a $2.3 billion market cap advertising company, and Amazon Publisher Services announced a deeper streaming TV collaboration with the company. So that really saw some move to the upside. And Amer Sports, thank you, Tim, for saying, Carol, you got to do this.
Yes.
Stack up about...
It's a big deal. I'm surprised you didn't leave with us.
But then what would you complain about? All right. Up about 19% in today's session.
Well played, Carol.
Company boosted its adjusted profit forecast for the full year and reported first quarter results that topped expectations.
All right, I hate to interrupt you again, Carol, but the President of the United States is now in the Oval Office with the Secretary of Defense. Let's listen in.
And Ronald Reagan wanted it many years ago, but they didn't have the technology. But it's something we're going to have. We're going to have it at the highest level. I want to thank Secretary Hegseth, who's been fantastic, and Secretary Rubio and Space Force Vice Chief of Space Operations, General Mike Gutlein. I also want to recognize Senators Dan Sullivan, Kevin Cramer, and Jim Banks, fantastic senators, great talents, great political talents, and people that love our country. In the campaign, I promised the American people that I would build a cutting-edge missile defense shield to protect our homeland from the threat of foreign missile attack. And that's what we're doing. Today, I'm pleased to announce that we have officially selected an architecture for this state-of-the-art system that will deploy next-generation technologies across the land, sea, and space, including space-based sensors and interceptors. And Canada has called us, and they want to be a part of it. So we'll be talking to them. They want to have protection also. So, as usual, we help Canada do the best we can. This design for the Golden Dome will integrate with our existing defense capabilities and should be fully operational before the end of my term. So we'll have it done in about 3 years. Once fully constructed, the Golden Dome will be capable of intercepting missiles even if they are launched from other sides of the world and even if they are launched from space. And we will have the best system ever built. As you know, we helped Israel with theirs, and it was very successful. And now we have technology that's even far advanced from that, but including hypersonic missiles, ballistic missiles, and advanced cruise missiles. All of them will be knocked out of the air. We will truly be completing the job that President Reagan started 40 years ago, forever ending the missile threat to the American homeland, and the success rate is very close to 100%, which is incredible when you think of it. You're shooting bullets out of the air. I'm also pleased to report that the One Big Beautiful Bill will include $25 billion for the Golden Dome to help construction get underway. That's the initial sort of a down deposit. And we have probably, you're talking about, General, we're talking about $175 billion total cost of this when it's completed. This afternoon, I'm also announcing that I will appoint, very importantly, General Gutlein to lead the ambitious new effort as the direct reporting program manager for the Golden Dome. Very talented man, and I'm very honored to have been the one that helped to have really created Space Force. Space Force has turned out to be a tremendous success. We were third in space, and now we're number one in space by a lot. It's not even close. And Mike is a four-star Space Force general, the recipient of the Defense Distinguished Service Medal, one of the most respected people in the world having to do with defense. You know, we have offense and we have defense. I'll bet he's good at offense, too. And he has an unmatched background in missile warning technology and defense procurement. General Gutlein also knows that we need to move fast. No one is more qualified for his job, and everybody, this was a universal acceptance of General Gutlein. Everybody that knows him and knows everybody else, they said there's only one man for the job, so I have a feeling we have the right guy. But now I'd like to invite Secretary Hegseth and the General to please say a few words and describe the system a little bit. And we appreciate you being here. The press has really been very fair over the last period of a couple of months. I don't know what happened to you. It was so much more exciting the other way. But you've been very, very fair. We have very high poll numbers, the highest we've ever had. And I think we're doing a great job. We had a tremendous trip to the Middle East, as you know. It was a really amazing trip. And now I came home, and this is the one I was really looking forward to this day, because this is very important for the success and even survival of our country. It's a pretty evil world out there. So this is something that goes.
And you're listening right now to President Donald Trump in the Oval Office making an announcement about a missile defense shield that he has dubbed Golden Dome. He is in there with the Secretary of Defense, Pete Hegseth, now taking questions from reporters. You can continue listening to those comments and his responses to those questions by typing live go on your Bloomberg terminal. And of course, we'll bring you any breaking news from that press conference as soon as we get them. Romaine Bostick here alongside Scarlett Fu. Alex Steele is off for the rest of the day. We continue our coverage here on Bloomberg Television with some breaking news crossing the wire right now. This involving earnings and Palo Alto Networks.
Yeah, the cybersecurity firm coming out with third quarter results, revenue beating analyst estimates just slightly. In terms of the outlook for this quarter, Palo Alto Networks giving a revenue forecast that basically meets the midpoint of the consensus estimate. But when you look at the bottom line, 87 cents to 89 cents, it meets the low end of the range. So it actually gives a higher than expected, slightly more narrow, higher than expected range for fourth quarter adjusted EPS. It also says that the next gen security annual recurring revenue will be anywhere from $5.52 billion to $5.57 billion. You are looking at a stock that is down about 3% in after hours trading right now.
You see those shares down. We're still awaiting on those earnings out of Toll Brothers as well. And keep an eye on Take-Two. Those shares moving lower on the back of a dilutive share offering. A lot more coming up here on the big program. Stick with us. We're going to get a better read on C-suite sentiment with Kevin Kajiwara, the co-president of Political Risk Advisory at Teneo. That's coming up in just a bit, right here on The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostick. Interesting thing happened today, Scarlett. It wasn't huge.
It didn't feel like it was in the market.
Stocks were down. Bonds were down on a price basis, and the dollar was down. And that's actually relatively rare. Now, of course, we saw this happen in a big way, in a much big blowout way back in early April. So to see a repeat of that gets to this idea of these sort of interlocking correlations, which is making it a little bit harder for the market to really find any direction. You saw that actually reflected in the price action today, and you saw it reflected in a big way today. The S&P moving lower by about 0.4% on the day. Similar moves lower for most of the major indices, with the Russell 2000 being the main outlier. But you're taking a look right here at the S&P Utilities Index, and I put that up there because that was your outperformer on the day. And not only was it the outperformer, it actually closed at a record high. And that probably gives you some sense into where folks' heads are at when it comes to right now risk appetite. Gold at the bottom there, that also gives you a sense of where risk appetite is, as well as people continue to pile into gold as, I don't know, maybe a hedge from trouble, or maybe it's just become a little bit more of a growthier stock. There were some bright spots out there. You're not going to necessarily find that in the cruise space, but you did find it in some other folks.
Absolutely. So let's get to some of those individual movers here. We'll start with D-Wave Quantum, because Romaine was talking about a bright spot. The stock up 26% on the day after announcing the availability of its next-gen quantum computing system called Advantage 2. Of course, it's not clear when the company will be able to book substantially more meaningful revenue from that system. We're also looking at Fair Isaac, down 8%, but actually it fell as much as 21%. This is the company that provides credit scores for consumer loans as well as mortgages. According to a note from RBC, the stock is down after comments from Bill Pulte, who heads up the Federal Housing Finance Agency, suggesting more competition for the credit rating company. So that stock taking a big leg lower. But our top story this hour is how it's a moment of reckoning for a pair of Mag 7 giants. Tesla stock touched a 3-month high at one point after Elon Musk signaled that he is refocusing on the EV maker. He told Bloomberg he will remain CEO for at least the next 5 years and that he plans to spend less on political campaigns. Meantime, investors are watching to see how Alphabet resets the narrative at its developer conference. The stock has underperformed its peers on persistent concern that Alphabet is losing dominance in the search market at a time when it's spending heavily on AI. We've got all that coming up later on in the program.
Yeah, some great conversations ahead in the tech space, but let's focus a little bit on treasuries right now. We did see a rise in long-term bond yields on the back of those ongoing budget negotiations in Washington. The 30-year yield still hovering just below that 5% threshold. Our next guest warns of big headwinds in fixed income to allow for summer volatility with increased U.S. debt deficit fears leading the charge. Joining us right now is Rashaan Reid, head of America's fixed sales over at Bank of America. Great to see you.
Great, thanks. Thanks for having me.
So let's talk about maybe what could portend for the summer. I mean, we talk about this tax bill working its way through Congress. We know that it's certainly long term, there could be some implications on bond yields.
Yes.
Where do they go?
Yeah, listen, I mean, the most important thing that we're hearing from clients is obviously the focus on what we call the fiscal term premium. And that is certainly being priced in the back of the curve. And therefore, there's a lot of focus on taking risk when you talk about adding duration risk. I think, you know, when we look at sort of where we've been, particularly if you look at sort of the Liberation Day, we've actually regained the rally that we saw. And we've had yields reset higher. Even just last week in our franchise, we saw the largest flows in U.S. Treasuries outside of January month end, and that's on a dollar DBO1 basis. So it is showing you that people are coming in at these higher yields and sort of buying, but the deficit and sort of the concerns around the fiscal picture is still plaguing the market and causing pressure on the back end of the curve.
Well, on that term premium, though, too, because, I mean, and I'm glad you point that out, because most of the activity still seems to be on the shorter end of the curve, and part of that is the differential isn't that great. And then when you look at the term premium, it's the premium that you would get in relative to equities, is certainly not where it would be on a historical basis. When do we start to see that creep up a little bit more? I know we kind of got that pop a little bit yesterday because of the downgrade, but then that kind of came right back down once for whatever reason.
Yeah, I mean, I think, listen, it is all going to center around also the economic data, right? And we know the hard data has still been overwhelmingly positive. And I think that is giving investors still some comfort that the market is resilient and being able to handle it. That being said, the deficit we know is going to add pressure and cost into the system. And so it's still a focus to, you know, make sure that you're in the intermediate parts and even the shorter part of the curve and sort of wait and see. But I think investors just want certainty, right? I think we'll continue to see volatility, you know, certainly over the summer until we know what the effects are and the cost in particular of the Reconciliation Act or bill and see how that sort of, you know, flows through the system.
I know the Moody's downgrade last week, I should say, was expected because S&P had already done it, Fitch had already done it, so it's kind of like, of course, Moody's was going to do it at some point. And the U.S., frankly, still has the highest credit rating, just not the tippy top of investment grade. Having said that, we did learn that Hong Kong pension funds are not going to be able to invest as much in the U.S. Debt market because they need to invest in only AAA or equivalent rated bonds. Do you think there's going to be more skeletons to emerge that are similar like that, where you have some funds saying, oh, wait a minute, because it's not AAA, we might need to reduce our holdings?
Yeah, by and large, when we think about the index and most people being benchmarked to the broader ag indices, et cetera, that investment grade rating is what's really most important. And so we haven't and we don't really expect to see broad-based selling due to the downgrade. As you mentioned, it was expected. I think the U.S. still landing where it is and with a positive outlook, despite the concerns about the deficit, which was part of the reason for the downgrade. I think that's still, you know, it'll certainly add more negative sentiment to the market, but we don't expect to see forced selling broad-based. When you talk to our money manager communities, et cetera, they're all still sitting pretty okay because it's still an investment grade rating.
Okay, got it. You mentioned the term premium and the long-term structural concerns about the widening deficit and the increased debt burden. Where should that term premium be? Or is that something that is still very much in debate, that's still very much being worked out?
Yeah, I think it is being worked out. Like I said, the uncertainty around certainly where sort of the reconciliation package, which we know will still add, you know, make our deficit grow and cause, you know, even more pain to where it is. I mean, there's some estimates out there. We're calling for even by end of year 26, next year, up to 7% as a GDP. So we need clarity on that. We need clarity on those costs. And I think we also need clarity on just, you know, sort of the Fed's toolkit and the Treasury's toolkit in terms of what they will use to support the back end of the Treasury market. We've been fortunate that when you look at the auctions that we've had, things have been pretty smooth. I mean, some of the things we look at is sort of the indirect participation and bid to cover ratios when we think about foreign buying. And foreign buying has been waning, and that's actually happened over a period of years. So that's actually not a new phenomena. But we want to make sure that there's that marginal bid for U.S. Treasuries in the back end. And so there are things that can be done in terms of increasing coupon sizes, WAM, weighted average maturity, all that is what we're sort of looking for.
But that comes from market pressure, and this gets to this whole debate about the proverbial bond vigilantes, which may not exist, or it might just be a myth in our heads. But I am curious as to how much pushback the market can really have on some of the policies coming out of Washington that are potentially going to be inflationary or maybe tamp down growth in a way where yields would need to rise.
Yeah, I mean, listen, I think the market speaks its piece, right? And they do it in terms of where they're deploying capital. I think they can do it in terms of being defensive and certainly shortening up duration on portfolios. I mean, when you look at sort of the front end of the curve, it's quite attractive. We actually like owning that. And, we're a little bit more skeptical on the back end in terms of being short 30-year asset swaps. So, but I think the market will, through asset allocation, show you sort of what's willing to accept.
But as investors sort of look at their allocations as well, and there was an interesting research note out by Henry McVeigh over at KKR who kind of talked about this idea, in his view, how he didn't really view government bonds as being the effective hedge that they're supposed to be, because right now the correlations with other asset classes, risk assets specifically, are so tight.
Yeah, there's some truth to that, absolutely. I mean, I think if you look at other asset classes where you have maybe structural protections, like if you think about the mortgage market, particularly agency market, where you can, buy in securitize AAA ABS, for example, and get more protection. I think that, gives investors some safe, some sense of warmness about where you can sort of be in the capital structure in terms of yield protection, as well as structural protection. So there is some truth to that. I mean, I think correlations have been a little bit off, certainly, just because we have such a structural change plaguing the market when you think about sort of the U.S. Treasury market. That being said, it is still the dominant market in terms of the global bond markets. And I always say, clients have to own treasuries in some shape or form. We just want to make sure it makes sense in terms of yield, risk reward.
Rashaan Reid, thank you so much for joining us today. Really appreciate it. Hope to see you back here. Rashaan Reid is head of America's FICC sales at BofA.
Great, thank you.
Coming up, Elon Musk committing to his role as CEO of Tesla. We'll have that part of the conversation next. This is The Close on Bloomberg.
Is that the best one?
Elon Musk brushing off concerns about Tesla's slumping sales and reassuring investors that he is committed to leading the EV maker in the next 5 years. He spoke at the Qatar Economic Forum in a conversation with Bloomberg's Michelle Hussein. Here's part of that interview.
Tell me then how committed you are to Tesla. Do you see yourself, and are you committed to still being the chief executive of Tesla in 5 years' time?
Yes.
No doubt about that at all.
Well, no, I might die.
Okay, short of that.
I can't be CEO if I'm dead, so there's a slight amount of time.
Does that mean that the value of your pay doesn't have any bearing on your decision?
Well, that's not really a subject of discussion in this forum. I think obviously there should be compensation for, if there's something incredible is done, that compensation should match that something incredible was done. But I'm confident that whatever some activist posing as a judge in Delaware happens to do will not affect the future compensation.
This is the judge who twice struck down the $56 billion pay package that was awarded to you. I think the value on the current value of stock options. Yeah.
Not a judge. The activist who is cosplaying a judge in a Halloween costume.
Okay, that's your characterization. I think on the current value of stock options, I think the actual
justice according to the law.
On the current value of stock options, I think the value of that pay package stands at about $100 billion. Are you saying you are relaxed about the value of your future pay package? Your decision to be committed to Tesla for the next 5 years, as long as you are still with us on this planet, is completely independent of pay?
No.
It's not independent. So pay is a relevant factor then to your commitment to Tesla.
A sufficient voting control such that I cannot be ousted by activist investors is what matters to me. And I've said this publicly many times. But let's not have this whole thing be a discussion of my alleged pay. It's not a money thing. It's a reasonable control thing over the future of the company, especially if we're building millions, potentially billions of humanoid robots. I can't be sitting there and one day get tossed out by, for political reasons, by activists. That would be unacceptable. That's all that matters.
Elon Musk there, the CEO of Tesla, in conversation with our very own Mishal Hussain over at the Qatar Economic Forum. This was an interesting interview. It got a little awkward at times, particularly given the delay. He wasn't actually there in person. You could see he was zoomed in. There was a little bit of a time lag, so it kind of made the question and answers kind of overlap a little bit.
Yeah, definitely. Yeah. But I did like to hear what he had to say about Tesla's sales overall and how Europe was fairly weak, but he sees them recovering really nicely.
Yeah, but we didn't hear that part.
Not that part.
All right. When we come back, we're going to take a look back at this day in history, a day when Microsoft, Intuit, and the personal finance software merger that never happened. That's coming up next here on The Close. This is Bloomberg. All right, let's take a look back in history to this day 30 years ago when Microsoft abandoned its effort to buy personal finance software company Intuit. Now, the saga has started about 7 months earlier in October 1994 when Microsoft announced a $1.5 billion stock deal for Intuit in what would have been the biggest purchase ever in the then burgeoning PC software industry. Now, it was an astonishing deal on many levels. Microsoft was paying a king's ransom of 12 times annual revenue for a company that had just went public months before. Furthermore, Microsoft had just settled an antitrust investigation into whether it was using its dominant market share to illegally buy up or crowd out competition. That's key. Microsoft, which already controlled almost all of the market for PC operating systems, was becoming a buzzsaw in its thirst to expand into application software. Failing or severely hobbling, WordPerfect, DBase, Lotus 123, Quarterdeck, Stacker, you name it, Microsoft slayed it or bought it. In 1991, Intuit looked like it was next for the meat grinder when Microsoft unveiled a competitor to Quicken called Money. Now, what it didn't count on was an Intuit CEO who was ready for a fight and a Justice Department that was on its last nerve. Intuit fought back, initially by lowering the price of Quicken. But ultimately, Microsoft Money struggled not because of price, but because of the stickiness of personal finance software. Remember, at that time, transferring data from one software program to another, that was cumbersome, if not impossible. So if you had already set up your personal finances in Intuit's Quicken, or filed your taxes through TurboTax, or set up small business payroll through QuickBooks, you would really need a compelling reason to go through the hassle of switching. Now, Microsoft got that lesson with Money in 1991. It got it again in 1993 when it released a competitor to QuickBooks called Profit, and again with TaxSaver in 1993. By 1994, Microsoft decided that if you can't beat them, then buy them. But the DOJ had other plans, making a formal challenge to block the purchase of Intuit. And that leads us to May 20th, 1995, when Microsoft chairman Bill Gates finally acknowledged the writing on the wall and said rather than face years of litigation, it was, quote, time to move on. Now, Microsoft, of course, is no worse for the wear. It is now the most valuable publicly traded company out there. And as for Intuit, it's done okay as well, growing from a $500 million market valuation to almost $200 billion today.
All right, we have some breaking news here from Toll Brothers. The home builder coming out with second quarter results on the top line, beating analyst estimates. In terms of its outlook right now for the third quarter, its deliveries does miss the consensus estimate. Nevertheless, the home sales gross margin for this current quarter, 27.3%, is in line, if not slightly higher than what analysts were expecting. For the full year, Toll Brothers has reaffirmed its guidance. It's maintaining its full year deliveries, and it sees its home sales gross margin of 27.3%. Again, consistent with what it is expecting for this current quarter. The stock marginally higher in after-hours trading, gaining 1.4% right now. Let's turn back to tech and head over now to Las Vegas, where Bloomberg Technology co-host Ed Ludlow is live from the Dell Technologies World Conference, focusing on the future of tech and innovation. Ed, what can you tell us about how the future of tech and innovation looks like right now?
it looks like the activity is outside the United States, right? Off the back of the president's visit to the Gulf last week, the biggest question that Dell has is how much of the deal is it going to capture? You know, very simply, what Dell does is take principally NVIDIA's technology, their GPUs, put them into servers, and those servers go into data centers. And in conversation with Arthur Lewis, who leads the Dell Infrastructure Group, he basically said, yes, we will start to do some more sovereign deals away from the SMEs and other sort of direct-to-tech deals that we've done, but didn't explicitly answer the question. Dell's stock has been an interesting story to follow throughout the day. At one point, markedly higher, closed flat as the rest of the market looked for direction. Also of discussion here is xAI. xAI is kind of like Dell's big anchor data center customer, and they are planning to expand that relationship. You'll see headlines on the Bloomberg terminal from Elon Musk about xAI's ambitions for the Memphis site in particular. But the main credit that Dell gets is they move incredibly fast. What they're not answering is, what does that look like? Are they planning to add more sites of xAI, double capacity, and where are the GPUs coming from? But that's the center of conversation here. And so the next question we ask ourselves, the next place to look, is where does Dell pop up in the Gulf states in particular?
All right, Ed Ludlow out there at the Dell conference in Las Vegas. Dueling conferences taking place right now. Let's see who had the better assignment. Out in Mountain View, California, Google's annual developer conference is underway, where the tech giant announced it would offer AI mode in search to all U.S. users. Bloomberg's Jackie Davalos has been on the ground out there in Mountain View, California. Jackie, what are we learning?
Well, I've learned that AI mode is really the next big thing for Google's search ambitions. This has been the biggest question that investors and users have had about where it goes next. How will they utilize the AI moment for its biggest and most profitable product in search? And so what we learned today is that AI mode will really kind of reinvigorate that tool and really make it much more conversational. You can't just only put in text, you can also incorporate voice and images, kind of making it this chatbot-like style search feature. And it's really betting that this is going to be kind of the next generation of search. It's also banking on its AI overviews, which it rolled out last year. It saw some pretty good traction there with 1.5 billion users using those overviews, so you don't have to go through all the links. It summarizes those up top for you. And it gave us an insight into how it's thinking about agents. Remember, this is also the next frontier in AI, and the company is betting that its integration into Chrome, as well as other products, will really, engage users in a way that is more proactive, where it can anticipate what you might need. Give a great example, in shopping. So this is something that you might be looking for a new pair of shoes. It might give you some options in how to search for that. Ultimately, it wants to do that work for you, potentially buy it on your behalf. We also had some unexpected announcements in hardware. Smart glasses, they're getting back into the smart glasses space, really starting to give Meta a run for its money.
Yeah, everyone seems to want to get back into that smart glasses space. Yeah. Of course, Google Glass didn't get very far the first time around, so we'll see how that goes. Yeah. Jackie, really appreciate it.
I don't know. I don't like this. Is AI just going to have my credit card and spend all that?
Well, the AI could. If you think it, maybe it'll happen. Jackie Davalos there reporting from the Google I/O conference in Mountain View, California. All right, let's take a look at how markets closed on the day. The Mag 7 dropping 0.6%. That's a big reason why the S&P 500 took a breather down for the first time in 7 days. I was looking at the daily swing in the Dow Industrials, only 314-point intraday swing today. On average this year, guess how much the swing is?
Over 1,000 points, I would assume.
No, on average 638. On the wildest days, definitely more than that. But it gives you a sense of how quiet it's been the last couple of days here as we wait for more headlines on trade deals and on the tax bill as well. 30-year yield creeping up once again, almost 6 basis points to 4.96%. Weaker dollar, also once again a consistent theme here, and higher gold. This is the close on Bloomberg.
imports are only 14% of the economy. The ability of those types of things to really move the needle on inflation are limited. We've been introducing tariffs since day one of this administration, and what we've seen as tariffs have started to come up has been no real meaningful macroeconomic effect on inflation.
And that was Stephen Moran, chair of the White House Council of Economic Advisors. Joining us now for more on how companies are strategizing through this tariff uncertainty is Kevin Kajiwara. He is co-president of Political Risk Advisory at Teneo. So, Kevin, through this earnings season, we've seen companies communicate the potential impact of tariffs in a number of ways, right? They have maintained their guidance but not included the impact, which they got punished for. They've pulled their guidance, too many to name on that front. They've offered a base case and a worst case like United. And in many instances, they've maintained guidances, but also said that they may raise prices. What is actually happening inside the C-suite? Walk us through these executives' calculus of determining just how much to reveal, the risks of saying too much versus too little.
Well, Scarlett, I mean, the evidence that you just put out there of all of the sort of the diversity of how companies and executives are articulating what their sensitivity is to inflation just goes to show that none of them are any more clairvoyant than anybody else at this point. You know, obviously there were concerns that we were going to see an increase in inflation. The most recent inflation prints have been very, very mixed. That the headline numbers have been pretty decent, but when you started to pick away, you saw what's bubbling up down there. And of course, late last week, we had some of the retailers start to suggest price increases are coming. And obviously, we're in this kind of reprieve moment with regards to the tariffs. There's been this 90-day suspension. We're about halfway through that of the reciprocal tariffs, right? That is looming out there, notwithstanding the quote-unquote deals that were cut with the United Kingdom and with China. They are supposed to re-kick in if all the rest of the deals aren't satisfied in the next 200 days. So my point is, or in the next 45 days or so, my point is that the impact of tariffs continues to loom out there, and it's once we get to a point where you have a good indication of what the final numbers are going to look like, I think companies will have a lot more license to be more precise, or they'll be demanded by investors that they be more precise on what those inflationary impacts are going to be on them.
In the meantime, they're trying to get a handle of the landscape as well. So can you talk a little bit about their lobbying efforts in Washington? Do you send the CEO out to make a trip to the White House and, talk to the president, him or herself, or do you do it from the safety of an industry trade group where with your competitors so that you won't be singled out and shamed out loud later on?
Look, I think it depends on a number of factors. One is the stature of the CEO. Another is, of course, the sensitivity of the industry that they are in and how sensitive that is going to be to any disruption of the global supply chain. So really, my colleagues at Teneo who are counseling these very CEOs every single day. You got to take it in a very customized perspective, depending on where they are in that spectrum.
But if you're a consumer-facing company, I mean, and even not just a consumer, even if you're a B2B company, there has to be some explanation of a higher price tag on your product, right? And if that price tag is going up directly because of tariffs, don't you have an obligation as an executive to communicate that to your customers in some fashion?
Yes, but I do think it's premature to say exactly where everything's going to wind up. What it looks like right now, Romaine, is that we might be heading toward what I would call the 10 and 30 model. It looks like we may be heading, and I wouldn't necessarily straight line this, but it looks like we might be heading toward an environment where there's going to be a baseline 10% tariff on most countries, 30% on China, and then there will be these added sectoral tariffs: steel, aluminum, cars, car parts, possibly pharmaceuticals, et cetera. If it winds up being a 10% tariff that your product is subject to, how you're going to be able to split that between the exporter, the importer, and the consumer, is going to impact how you're going to have to communicate that. If you're going to put it all onto the consumer, that's one thing. If you're willing to accept margin hit for some period of time, that'll be something else. So I think there's no one size fits all answer to this question is the issue.
And this gets to this idea then as to what the marketing, I guess for lack of a better word, or salesmanship of it is going to be. And is that the CEO's job, or is that something that he or she can put off on their deputies, so to speak, to sort of go out there and try to find a narrative that their customers is going to be palatable for the customers and maybe even palatable for the White House and the president?
Well, Romaine, I think that tariffs right now is the subject du jour, but we know that it's about so much more than just the economy. It's about so much more than just trade. It's one of many really geopolitical issues. It's one that obviously touches CEOs and companies more directly than a lot of the other ones. But all that to say that I think in this environment, the CEO has to be the chief political risk officer of a company. We're making strategic decisions now. It is going to be incumbent on them.
Even if some of the requests are maybe unreasonable. I mean, I think back to the comment from Trump the other week about Apple moving its production to India. I mean, even if Tim Cook wanted to abide by Trump's threat, I mean, that's not something you just can unravel in a day or two.
No, but let's be clear. I think Apple and Tim Cook have been under this pressure before. I mean, President Obama asked Steve Jobs why they couldn't make the iPhone in the United States. There are good reasons for it. It's complicated. There's probably nothing more complicated or more emblematic of the global supply chain sort of perfection than Apple.
So we pay so much attention to it because Apple is a U.S.-based company, but it's a global company. It relies on sales to the rest of the world. And that brings us to this idea that as much as everyone's fixated on U.S. tariffs on other countries are still making deals with each other as well. How are CEOs thinking through the logistics, the strategy with that while staying focused on the uncertainty of what's happening with the U.S.?
Well, I think number one, it is being as best informed as you possibly can be about the fact. I mean, it's so easy, right, to over-index on exactly what's happening in Washington. The noise and the velocity is just so great. On the other hand, this time around, Trump 2.0, other countries are not standing still, as we have seen. The deal yesterday between the EU and the UK, India and the UK, EU and Mercosur. A number of the Latin American leaders were just in China last week. Xi Jinping did a trip throughout Southeast Asia the week before. So there's going to be, I think, an increased move to more bilateral and even multilateral deals that are going around the U.S. Remember that global GDP or trade as a percentage of global GDP has remained constant since Trump 1.0. It's about 60% of global GDP. It is going up in most of the world. Trade as a percentage of GDP, as the White House just pointed out in your clip a minute ago, is going down. It's 25% here. And if you look at the 10 fastest growing trade routes in the world, only 2 of those have a terminus in the United States. So trade, there are going to be a lot of countries that continue to believe that free trade and the principles of free trade are to their benefit and to the benefit of their companies. So, increasingly we may see trade around the U.S. in addition to trade with the U.S., kind of working on two different cycles.
That's really interesting. All right, Kevin, got to leave it there, but got to get you back soon. Of course, Kevin Kajiwara is the co-president of Political Risk Advisory over at Teneo. All right, stick around. We're going to set you up for what to watch over the next 24 hours. That includes some earnings out of more retailers. Stick with us. This is Bloomberg. All right, we got earnings this morning out of Home Depot. We get several other retailers over the next couple of days. That includes Lowe's, Target, and TJX tomorrow. Ross Stores and Deckard's on tap for Thursday. Joining us right now is Adrienne Yih, senior retail analyst over at Barclays, who covers TJX, Ross Stores, Urban Outfitters, and quite a few other retailers out there. Retailers, of course, that Adrienne, have been in sharp focus primarily because of the concerns about tariffs. Let's start with TJX because there's sort of 2 things going on here. First, on the tariff side. Should we be worried? I mean, do they have outsized exposure to imported goods?
So they do not. What we like to talk about is separating companies into 2 buckets. Those who have first cost. So first cost are vertical retailers like a Gap that directly source, or the brand manufacturers like a Nike, who also directly source. So the off-pricers, which comprises TJX, Ross Stores, and Burlington, they get pass-through cost. Not only do they get pass-through costs, which is basically the brands selling to the retailers at frontline who then don't sell their product, they actually solve a problem. right? So they kind of clean up and liquidate kind of all the excess inventory in U.S. retail. So they really tend to be in the driver's seat when they do go to market and negotiate against either the retailer or the vendor.
The other side of the coin, too, with TJX is the economic factor, right? The idea that TJX is a discounter, and typically it tends to be a little bit more resilient when times get tough and folks are looking for bargains. But I'm looking at analyst estimates for the year for comp sales, as well as for profitability, and those are kind of trending down. Why?
Yeah, what I would say is if you think about the last 2 years, 2023 was a cleanup from that excess inventory glut that we had in 2022, and it was mostly at what we call frontline retail. The year two was kind of, the frontline retailers kind of pulling back on inventory and purchasing from brands like a Nike, like an Under Armour. And so we had 2 years where we actually had inventory, first from the retailers, and then secondly from the brand manufacturers, that was kind of, helping out and kind of like really, really good, juicy inventory. I think that what's happening is people have this notion that the consumer is going too slow, and that there was this concern that maybe we would have inventory unit shortages. And so people are kind of baking that in more as conservatism, and allowing sort of the off-price model to show the strength and the power. But you would need to see trade down, right? So the underlying trends, according to kind of the sell side, model, would suggest that the supply side of things, the inventory that's out there, may not be as juicy. Now, we all know that these estimates that are out there are pretty much for the most part, pre-April 2nd. So, to the extent that it gets juicier, that's probably the case.
I look at TJX, and 22 of the 26 analyst ratings are buy. So people are very bullish on the stock. It's trading at 33 times reported earnings, 30 times estimated earnings. At what point does this become a little bit too rich because of all these tailwinds, these structural tailwinds and cyclical tailwinds it's enjoying?
Scarlett, while all of the other companies in retail have had their multiples contract, you've actually seen a flight to quality. And you've actually seen TJX hold what's actually almost 5 turns higher than their 3, 5, and 10-year historical PE. So what people are saying is that any sort of disruption, right, inventory that doesn't land on time, inventory that gets canceled from China, inventory that gets redirected from China to Europe, per se, all of that is dislocation, and that is textbook fodder for the off-price channel. And TJX is uniquely positioned with 20% exposure to Europe, as well as the U.S. to profit from that.
Okay, so it sounds like a win-win situation here for TJX and its off-price retail peers. Adrienne, thank you so much. Adrienne Yih, Senior Retail Analyst over at Barclays. Romain?
All right, a lot more coming up over the next 24 hours that could potentially move markets. Some of those big earnings that we just talked about, including Target, including Lowe's, including TJX, a couple others on there as well. Baidu, which we haven't talked about in a while, and Snowflake, so 2 tech stocks to keep an eye on.
Yeah, but this is really the tail end of the earnings season, and I got to say, it's the retailers that are top of mind here, given their exposure to tariffs.
So Baidu and Snowflake also reporting. Also, we're going to get mortgage application data at 7 a.m. Eastern time. But really, the star of the show tomorrow is going to be this exclusive interview that we have with the Speaker of the U.S. House of Representatives, Mike Johnson, as that tax bill, that reconciliation bill, Scarlett, is trying to work its way through Congress.
Yeah, that'll be at the 9 a.m. hour. So it'll be with our very own Anne-Marie Hordern. And of course, the big question here is whether he'll be able to get it done by the end of this month.
Yeah, well, he said he would get it done by Memorial Day, which is Monday here in the United States. It does look like they are making progress. We are going to get some Fed speak as well, if you care. Bark and Bowman on tap to speak about that. As far as that Mike Johnson and that reconciliation bill, we can find a lot more about what progress is being made on that with Kaylee and Joe and Balance of Power, which starts at the top of the hour right here on Bloomberg.